everybody. I'm Jodi Hubler. It's a pleasure to be with all of you. I will warn you, my husband this morning observed, he said, I don't know that I've seen you kind of this amped since you ran the marathons, Twin City Marathon. And my running group forced me to go run a block before I came back, partly because I am so excited to share this opportunity. And I said to the groups that are going to spend the day with me, there can be 10 people and we're going to have a really intimate conversation. There could be 100 and we'll overflow. I actually don't care. I am equally as passionate about the opportunity to talk about convergence. And I think Kathy made mention of it in the overview. That passion really stems from my own personal belief that we are sitting at an inflection point. We are on the precipice. We have converged. We have had multiple industries, entities merge, and hopefully throughout the next 4 hours you're going to hear not only from a group of investors, 2 CEOs, and another group of CEO panels from across the constituencies. But I'll also be honest, a lot of times we spend a lot of time talking about the Star Trek technology, or we talk about the Flintstones chassis, and we don't talk about the bridge in between. And that was the real push to talk about convergence, to really spend some time talking about the implications, the things that we can get really, really excited about, and then deal with the realities and the practical transitions that are taking place in and amongst. I run a healthcare services venture capital fund. We're going into our 13th year. We have invested in healthcare services across the entire ecosystem. If it has to do with financing, transacting, retailing, servicing, and infrastructure, we've been a target for investment. We also started in 2006, and in that year, there was less than $1 billion that went into this space. When we first started, there were people who told Tony Miller, our managing partner, that we were crazy, that you couldn't make money in healthcare services, that there was no opportunity. Healthcare is where tech went to die. It wasn't where it came to innovate. And there were a lot of questions about a female-led venture capital fund, which has been interesting now 13 years later as well, but that can be a different panel for maybe next year's Manova. But I am thrilled. I'm thrilled to share the stage with a group of people that I had the opportunity to handpick for a variety of different reasons that are going to become self-evident over the next hour. So I'm going to start off with a thank you to the panel and ask them to introduce themselves, and then we are going to get into the meat of the discussion. So thank you very much for being here. Allie.
Hello, I'm Allie Lovett. I'm a partner at Radian Capital, a growth equity firm based in New York, fairly new, and I'll sort of get into why I was excited about starting the fund. We invest in B2B tech and tech-enabled services, and Jodi told me to keep it short and sweet so we could get to the interesting stuff.
Hey everyone, good afternoon. My name is Brian Callis, and I'm part of Accenture's strategy practice. With that, I lead our digital health and innovation practice, working with health plans, health systems, life sciences companies, and to the topic of convergence, everyone else entering into healthcare. So excited for the discussion today, and glad to be in our own town here.
Hey everyone, I'm Ryan Broshar. I'm the managing director of Matchstick Ventures. We're an early stage tech VC based here in the Twin Cities. We've done now over 50 investments over the last 4 years. About a third of those are in the Twin Cities, but the other 2/3 are really across the country, including some healthcare focused startups. I also am the managing director of Techstars here in the Twin Cities. So we have a program that is with Target here downtown. It's retail. We also have a farm to fork program in St. Paul, and around the world we have 45 programs around the world, including one in healthcare that is based in LA. Also this week is Twin Cities Startup Week. I don't know if, has anyone else participated in any other events? Startup Week, maybe? Yeah, we got 1, 2. This is also Twin Cities Startup Week. I founded that 4 years ago, in addition to another organization called Beta.mn, which is a nonprofit organization based here in the Twin Cities.
So he obviously doesn't sleep like the rest of us might do. So Kathy Toon, I am the founder and managing partner of Fourth Element Capital, a new fund that is focused on medical technology and technology-enabled devices. We are just getting started. We've done a couple investments. Before that, I was with Thomas McNerney and Partners, a healthcare technology investment firm that was based here in Minneapolis as well. And I'll stop there.
All right, so Brian, you bring in the Accenture perspective. Each of us can represent an area that we'll go deep in, but I think it's important for you to set context for us. And so as we were preparing, you and Accenture are viewed as thought leaders really around the whole entire ecosystem. So can you pick a few areas that you'd like to set the stage for us, kind of just give some context to this idea of convergence right now?
Yeah, I think part of this is just a bit of the why now and what's different. So in terms of the why now, why are we seeing convergence? And generally what we're seeing is just a convergence of a number of external environment factors, both regulatory, technology, consumer, as well as economic, all happening at one time that ultimately are shifting the basis of competition for traditional healthcare incumbents, as well as increasing competitive rivalry. And I think what's unique about that is that's causing value pool shifts that are causing both investors as well as traditional incumbents to realize that there's opportunities to fundamentally change the system and to do so in new and different ways. You also see that, and that's what's appealing with non-traditional entrants like the large technology platforms. They're sitting there seeing a lot of the inefficiencies and waste that exist in healthcare. So with over 20% of the cost of the national health expenditures being waste, there's this question of, well, how do we do that more efficiently? How do we increase labor productivity and reduce a lot of the waste in the system? And they're looking at, well, how do we bring both the capital we have with data and analytics, as well as close connection to consumer, to kind of address some of those issues.
So talking about consumer, Ryan, you obviously through the TechStars program and the partnership with Target really focused on retail, but you also, I mean, Kathy made fun of it, but you do wear multiple hats between your own venture, seed, angel, entrepreneurial, TechStar. So where do you see the perspective? Where do you bring in the convergence play?
Yeah, well, I guess when I think of convergence, it's a lot of it is around kind of the startup community meeting the corporate community and going down the middle. And I think that's really where TechStars kind of can really help. You think like, if you're thinking of the corporations of using startups as outsourced innovation, if you will, that's easy to say. It's really, really hard to do on both fronts. It kind of comes in two ways. One, it's hard for the startups to get to a level where they can actually interact with these large organizations and really understand the nuances, the politics, the funding mechanism, the budgets. Like that is so different from a team of 3 working with a team of 3,000 plus, or wherever that comes from. On the flip side, there's the other side of the corporations coming down to a level to be able to actually work with them, and there is a give and take down the middle, so that we can actually have them interact with each other in the way that the startups can see the benefit from the relationship, and the corporations can see the innovation come in-house with them while not trying to kill each other one. And that's a really hard needle to thread. And we do that continuously within our TechStars program and try and mentor both sides of the equation to make sure that there's a value outcome.
All right, so Kathy, next. Clearly you, and particularly in this community, are well known around medtech space, both your past, present, and future, where you're headed. Medtech has had its time in this town. It's also been, some would view, under attack through various elements. And I did prepare Kathy because I wouldn't be able to quote it verbatim, but literally just this week a recent piece began with a recent news report from medtech industry has stark message: tech coming for you. A new report extorts that the medtech industry needs to invest in customer-centric capabilities and digital collaborations to build personalized health solutions, you could probably claim bingo at this point, or die by being outgunned by tech companies with deep expertise and data-driven consumer solutions. So I warned Kathy, I plan to bring this up at the conference. I mean, clearly, headlines like this, right? They're fun to read, to note, and but there has been a shift, a movement towards the medtech industry. And I think that is one of the underbellies of convergence, is that kind of like we talk about, innovation is often taking somebody else's revenue to cannibalize for their business model. MedTech has had its fair share of bites of the apple here. So where do you sit in this convergence? What's your view?
Yeah, I mean, it's been an interesting, past couple decades, I would say. I mean, we think this is new. This is not really new. I actually went back to some data because I've been in this industry for a very long time, and I thought, well, wait a minute, convergence has been happening in healthcare for a really long time, and the first couple approvals in the space happened one of them was 1998. Artificial intelligence to read mammography was approved in 1998, and there were some other pathology approaches in about that same time. Those were early technologies that took tens and hundreds of millions of dollars to get approved, that today, you could get that kind of thing approved pretty simply. So you had to break, I guess the point is, you had to break a lot of ground, and you had to have a lot of capital to be able to do that. And then you had to get it paid for, and you had to get it accepted by the community. And so, it's been a long, long road. I think we are definitely getting there, but I think to think that healthcare hasn't been adopting these things is not actually true. They have been adopting these things, but there's a huge set of barriers out there for medical technology companies, regulatory barriers, reimbursement barriers, adoption barriers, and those things are so much more substantial in this industry than they are in other industries that it's not simple at all. And there was a quote I had pulled out of a report as well, and it says, the challenges facing digital adoption. So the ability of digital medicine to become a global standard of care supposes that it achieves a critical mass, and that means doctors have adopted it, regulators are comfortable with it, patients are demanding it, and payers are covering it. That is a massive challenge, right? And it has taken 20 years for that kind of thing to all now come together so that people can actually get there faster. Regulatory parties have come a long, long way, and reimbursement is getting a little bit better. And I do think the industry, though, to your point about this report, the industry has not done a good job of really promoting the fact that they are leading in some ways. They don't use the buzzwords. They don't use the kind of language that is used to market themselves to say, we do this too. This isn't just about the consumer. We are already there. And so I think they could do a better job, actually, of promoting these things. And I guess I might end in, there are some great technologies. We've got Propeller Health that's doing asthma medication tracking. We got Medtronic has a closed loop artificial pancreas system. And that one in particular, this is life-saving or potentially life-threatening if done wrong. These are technologies that are actually so complicated and do result in substantial health detriment or benefit that you can't just go there as quickly as a lot of technologies can.
Okay, Allie, newest to the ecosystem here in the Twin Cities, but not based here in the Twin Cities. Also coming from a different part of the ecosystem, really laying claim to the Twin Cities market and to healthcare. Tell us a little bit about why you're looking at this space.
Yeah, so Radian's a fairly new fund. We closed on $150 million in February of 17, so still in the process of deploying Fund 1. I think the decision for my two industry peers, Jordan and Weston, and I to start Radian was driven by two things. One, sort of the desire to do something a little more entrepreneurial. I don't think a lot of investors get to do that, and the idea of building a culture and a brand and an investment strategy from scratch was pretty compelling. I think more importantly, though, we all had a desire to get back to investing in the types of companies and partnering with the types of entrepreneurs that we loved most. And those were companies that we had gotten away from a little bit in our predecessor funds. So as fund sizes had increased, there was just a greater pressure to put more dollars to work in every single deal. And we were moving up market from a check size perspective. And what that sort of revealed to us was there were plenty of companies that were sitting in this really unique spot where they had figured out product and market fit. They had maybe scaled their businesses to $5 or so million of ARR. They had decided to build their businesses in a really capital efficient manner and needed a partner to help them figure out this really interesting and unique challenge around growing from, say, $5 to $50 million. And so what we thought was that needed a $5 to $25 million check size, while still focused on businesses that were actually, dare I say, cash flow positive or actually generating EBITDA, maybe at the expense of a higher or a lower top line growth rate. And so as we set out to identify opportunities that existed, what we found was, despite being in New York City, we actually didn't really care for businesses based on the coasts. And so the cities that were best aligned for us were those in, sort of 5 through 25 of the US and select opportunities in Canada. And so as I thought about that and I figured out what, as a healthcare investor, what mattered most to me was ecosystems that were really important within healthcare, that had a number of constituents across the healthcare ecosystem as opposed to just concentration in any one given area, and where entrepreneurs were building their businesses in a capital efficient manner. And the Twin Cities area proved to be a really great sort of melting pot around that, and an area that I'm hopeful to make an investment over the next 12 to 18 months.
Okay, so thank you for at least letting us get some grounding in each of their perspectives. I think we'll start throwing out some various topics. I'll set the context at least at this from an investor perspective. We've had over 30 billion flowing into the space. As I mentioned, we didn't have $1 billion in the first year in 2006 when we launched. Services wasn't really a play. And in this town, it was pure medtech, med device, and you really kind of kept them apart. We're starting to see now where that movement and the convergence coming into play. You have Medtronic doing a value-based contract for care management for a large hospital system in Pennsylvania. You have a plethora. I mean, Startup Week has 200 events going on this week. So some of the opportunities, I'm going to jump to one of the Rock Health released their third quarter results. Brian, I think they talked about 6 billion. Are we up to now? I mean, we had a phenomenal number. Yeah, a phenomenal number. We've already met 2007's number in this time period. So they've talked about it's never been a better time to be an entrepreneur. That we even talked about at some points that we've met our social moment between Shark Tank and a variety of the other entrepreneur weeks. A friend, Steve Krause, was recently quoted as saying, he always now shorts the HBS grads. In the day it was the real estate market, then it was the bankers, now it's everybody wants to be a CEO. But we hear from some entrepreneurs, and I know there are actually CEOs that I know in the room that are really struggling to get funded, and that are finding that while there's all this press and hype about it, there seems to be this, not even a bell curve, I mean, there's a chasm between those that can raise capital, those that can't, and then finding good sources of capital. So Ryan, putting you on the spot just to get it started and then others chime in, how are you advising in Techstars, how are you advising folks about that whether it's the first raise or the next raise in this marketplace? What are you seeing?
Yeah, if you look at the data even further, you see while there's so much money going into startups, what we realize is that a lot of that money is coming at later stages, right? And there's actually a bit of a gap when it comes to true seed stage rounds of, let's say raising $1 million plus on a company that's doing, very little revenue. Like, how do you even get to that next level where then all of a sudden you can get into the mega rounds where, the large volume of that is. So when we're in Techstars, we really focus on, what is your main differentiation of your company? Who are those investors that are willing to do that? And really starting to build those relationships out way out ahead of time. Because the best time to be fundraising for your startup is when you actually don't need it. And that's really where you lay the foundation for the actual fundraising process, which is when you actually kick it off. The best scenarios that we see at Techstars, and we try to build a lot of relationships, a lot of different people from there. We have this kind of great platform for people to tell their story and really get their business straight before they actually go out and do the fundraising post-program. But we try and lay the foundation of building those relationships way early. They can come along for that journey for them. They can build trust. They can build a pattern of execution that people can feel safe with. And then when they actually make that investment, it's de-risked to the level that they feel comfortable with. If you just approach someone off the street and just say, hey, I'm fundraising, here's the, are you in? Like, it's going to be a zero. Like, no one's ever going to do that. But if you have, this relationship and you're bringing them along for the journey, I think it's very powerful. And then the ask doesn't even really have to happen. It's more of saying, we're thinking about this, and then it's just a much more natural thing to play out.
So Brian, you recently did a LinkedIn post around the implication of pilots, and yeah, you actually used some, not strong words, not you dropped the bomb, but you definitely made it known. One of the underbellies that's talked about is just death by pilots, and so I'm curious, as you're observing the ecosystem at large, how are you either advising your practice, your startups? What are you seeing in that same kind of race to capital that's non-existent for some?
Yeah, there are a lot of layers to this one. So one, I'll play off what Ryan was saying and just the general tone of, yes, there is a lot of funding. So what is that doing? That's creating a lot of supply of solutions. That doesn't necessarily mean demand is ready for that supply. So good news, we have a lot of different solutions and problems out there. We're just starting to see the uptake of traditional incumbents starting to figure out and more meaningfully figure out how do we play. Take Techstars as an example where, like, your collaboration with Cedars-Sinai as well as Target being ways of trying to create some of those more meaningful connections. But what you have in the wake of that is a whole collection of people trying to get access and running pilots, but seeing pilots all the way to the death. You know, if it takes 6 months to contract, get through a HIPAA audit, and then 12 months later, and before you knew it, you're out of cash runway. So a big focus on this, both talking to traditional health system as well as health plan customers, is one, trying to guide them in advisory, going, well, are you serious about this? Like, and if so, you have to work with this company in a different way. And if so, what are you going to do if this scales? And actually providing that advice of going, if this actually proves this, you better demonstrate that you're serious and that you'll take it to the next level. And we're starting to see a number of the traditional enterprises start to put systems in place to be more mature in that, and then use this, as you were saying, Ryan, as external R&D, whether it's through investing themselves, acquiring them and internalizing them, or just bringing them to a network of others to scale.
Kathy or Allie, any comments on the entrepreneurial side of kind of advising in this marketplace right now?
Yeah, I think, so I focus more on the med tech. I guess the overarching theme for us is regulated and reimbursed. And we like that because those are barriers to entry for the next party to come along. So because then of that, it takes more money to get to any proof point, to get approved, to get revenue. It's not year 1, year 2, it's year 8 or something longer. And so I agree, there's a big gap in that specific area. The gap, the seed, the friends and family round is not where the gap is. That money is here. There are a lot of experienced executives, former executives who play in the angel space. But you need a lot of money ultimately, and to go to do a PMA, a large regulatory process, you need tens of millions of dollars, and that's not angel. That is large investors and institutional investors, and there's a gap for that. Call it Series A, or we might call it the seed round. That is more institutional, preparing for the next round. And my advice to people is, that you've got to be preparing for all these rounds. You've got to have the right investor base to be able to go out and do the next round. Unlike some of the tech areas where the seed investors are seed, and then they're done investing. And then the next group of investors come in, and maybe some do the BC round, but many do seed or A, and then that's what they do. And in medtech, that's just not the way it typically is. You really need that institution who's there as your partner throughout. So it's a different group, and that A spot is a pretty tough spot today.
Yeah, I just add sort of an observation for myself as an investor. One thing I've learned, and one recommendation for entrepreneurs. I'll start with the second. Obviously, it's a great time to raise money, and it's a great time to be a seller. Raise what you need, not what you can get. I think one of the biggest challenges we've seen in markets like this is entrepreneurs who have raised too much at too high valuations. And there's just fundamentally economic misalignment between the entrepreneurs and the investors. And what happens is a CEO can build a really nice business over the next sort of 2, 3, 4 years, get an inbound strategic offer that is quite compelling, but because those investors are not going to achieve a return profile that they expected, there's just economic misalignment. And given I'm often a minority shareholder, I care quite a bit about being, on the same page as the CEO. So if he or she wants off the bus, I want off the bus too. And I hope to be in a scenario where we are both going to be equally as excited about the outcome. In scenarios where I feel like I am being pressed to get into a valuation that's higher than I feel comfortable with, one of the sort of tools in any investor's toolkit is structure. And so oftentimes we might propose participating preferred securities, which gives us sort of significant economics on downside or mid-case outcomes. And I don't love doing this. I know I'm going to be probably unfavorable in the audience with any fellow investors by saying this, but all other things being equal, I'd much prefer to be in a straight convertible preferred, where each incremental dollar of equity value that's created in the company, we all share in that upside, because memories are short, and when we ultimately exit and the outcome is okay, entrepreneurs tend to forget why we structured a deal at that sort of way in the first place. And we've had a lot of bad blood on those exit outcomes, but we're not going to ultimately, given I work for my limited partners, go back and retrade a deal 4 years later. So I would just be very cautious about making sure that both parties feel, I guess, equally unhappy about the valuation, and then you know you've sort of struck a good deal. From the investor perspective, in this environment, I've learned it's really important to build conviction and build conviction quickly. I was actually participating in a banker process recently for a company, and it was a really traditional two-stage process where they asked us to submit LOIs, and then we would move forward, get access to management, and ultimately put forth a term sheet and see if we could strike a deal. And I was waiting for feedback on the LOI, and I called the banker, and he reached out and said, oh, I'm sorry, a private equity fund preempted the deal, promised to close in 2 to 3 weeks with no additional access to management. Now, for the venture community, that actually might be reasonable. For growth equity and private equity, that's not typically what we see. And I think it just underscored the importance of, if you like a theme and you've identified a company that solves a real pain point that buyers are interested in today, you got to run hard. You have to develop those relationships with management early on and convince them why your money might be greener than others.
And it'll be interesting to see in 2 weeks if they come back again. Because I've been on the other side, and there are some in this room that know. I mean, to be on the other side of that, grandmother wisdom, if it's too good to be true, it's too good to be true. So the idea that you've got a promise to close without any further access to management, giddy up, right? Good luck with that. The valuation side of things, I mean, it is, and other panels, and we're in a smaller room, but we're taping, and so I got to figure out how to behave, because in others we'll talk a lot about the advising to entrepreneurs around valuation envy, right? That we walk around with the, I'm worth 200 million, and you're in but your revenue's $1 million, right? So you're not really worth 200 million yet. Somebody was willing to talk to you about being worth 200 million, giving you some money, which means you're actually growing into a cap stack. And so how are you guys seeing valuation play out, particularly advising to those that really feel like there's times where that needs to be a metric of validation when there isn't, a lot other than, your parents being proud of you at times, or early pilots, I mean, how do you advise on valuation in a way that gives them that confidence to have some wisdom about what they're going to grow into the long term?
Yeah, there's definitely some trophy chasing when it comes to valuation, but we always advise our startups that, with valuations equals expectations. And those expectations have to be met in order to have a successful relationship with any investor. So while there are probably times to try and maximize for valuation, there's definitely times when you're not trying to maximize for valuation, because you're trying to set an expectation of what you realistically think you can get into, so you don't have to have those awful conversations 18 months from now or later. The other thing that's kind of interesting that we see is when corporations or strategic investors come in, and if they actually lead the round, and how that ends up playing out in the valuation. Because a lot of times their motivation isn't necessarily like, oh, we got to own a certain percentage of the company, or I've got to see a certain return profile like it is for like a true venture investor. It's much more of like, we want to dip our toe into this and learn. And that can actually throw off the whole downstream effect of that, especially if they're like, we don't really care. We only want to own so much. How much money do you need? And it's not really setting an expectation. Their expectation is just to learn. And when you go beyond the learning phase and actually have to go back to the venture community to raise that next round, and if your previous valuation was super high, it can throw everything off downstream. So we try to be very strategic when we advise on that. Additionally, having some sort of strategic investor lead around can always be really tricky, especially at a very, very early stage, because you may be ostracizing yourself out of working with competitors, or there may be some other risks associated with them being on the board, or whatever it may be. So we always try and make sure that it's aligned, and that it actually makes a lot more sense to have a true investor or a seasoned venture capitalist on your board instead of a strategic, in a sense that the interests are much more aligned around the ultimate goal of the company and not just a learning exercise for the corporation.
All right, so Kathy and Brian next, but Kathy, I'm curious, playing off the strategic piece, I mean, we've had a number of folks here in town take on both strategic investing, where medtech used to have actually more selling into and doing the pilots, and a number of folks starting to take on not only the G-Beta, Techstars, a number of entrepreneurial kind of programs, as well as direct investing. What's the implication been for the venture community here in that medtech, med device space?
Yeah, and in medtech, it's been, these corporate entities they're in and they're out, and it varies by management teams and CEOs, et cetera. But currently, it's quite, medtech investors are very active. I think for the medtech community, the money isn't flowing as it is in some of these other spaces for the pure medtech. And so having the corporate parties involved in investing directly has been critical, actually, to the space. They have provided a lot of capital flows that have been needed. They've been coming in early. Some have been very active at acquiring and structuring deals. And so for the current environment, which has been going on for probably the last 8-ish years, it's been very good and very active. And I think that it'll change again at some point. But I think right now it's been definitely very much a positive.
Brian, obviously sitting at Accenture, again, you get that global view and perspective. You and Kaveh do a significant amount of advising to companies across. This issue of convergence, you had Bose just announced today, I don't know if a number of people saw that they got the approval for the hearing aid, right? Talk about jump the shark here in town for a number of folks near and dear, right? You get Disney working with Texas Children's to change the entire patient experience. You get the cross-industry section, when we used to talk about why can't I get the Fandango, why can't I get the Open App, why can't I get my, it definitely has changed. So when think back, when did you know that it was starting to change? Do you have one of those moments, and then as it started to change, how has that changed your role giving advice and or looking across longitudinal?
Yeah, there's multiple ways to answer that. I thought it changed a while ago. So if anything, I'm realizing, you were actually way ahead of before it actually started to change. So where I started to actually see the first signals, or where I was, as I would go into wave 2, was when you started to see mobility take hold after iPhone and App Store, and so you started to see this early wave. And that's when you started to see Rock Health enter, Startup Health, and you're starting to see funding reports come. So dating back to roughly 2011, 2012, you start to see that start to uptake, both in terms of the amount of money coming in and the new entrants starting. So I started to signal that going, this is happening. Now let's fast forward to my view of, what's really happening. Realistically, I'll go back to probably 24 months ago at best, where I'm actually starting to see real change and something different, going, wow, we saw the signals, but now it's actually happening. And when we move beyond large mega mergers that were scale plays, to an Anthem and Cigna, to an Aetna CVS, to an Amazon entering supply chain, that was more of a moment of going, I knew this was going to happen. It was just a matter of how long it would take. So I think seeing those trends start to actually take hold and happen at such a scale where it's not just one or two examples is where, I'll go with past 24 months. Take also what you're seeing with traditional medtech and others moving into the converged spaces. So Medtronic acquiring Maser Robotics, regulation shifting, allowing Bose to come in. So it's because of just the complexities of the regulatory environment and so forth in healthcare, you're seeing it happen in these niche spaces and at scale. So
how do you guys, others, and I'll toss this out to any of the three from a pure investment perspective. We've talked some on calls about the impact to diligence and the diligence cycle across the ecosystem. So whichever of you want to jump in first here, but I think touching on this issue of convergence and the implications to diligence, both from an investor perspective, advising companies perspective, and or the cycles changing. What might have been a pure, here's where FDA, here's where the reimbursement is pure play. How's it affected diligence? Allie, do you have anything there?
So I guess I'd say traditionally, most term sheets we're submitting, we have a 45 to 60-day diligence process, and that's not really cutting it anymore. I think there's too much competition for us to be sort of starting from a standing start. So a lot of the times we're trying to have as many conversations with the key stakeholders that would be ultimate buyers and really ascertain their pain points, understand if they were to force rank it, how likely they would be to be buyers. So we're almost covering the market diligence question up front. I think it sort of goes into some of the learnings that I've had around not necessarily needing to be a specialized healthcare fund, but a specialized healthcare investor, because the jack of all trades just doesn't cut it anymore, in my opinion, and so you end up being a master of none. So making sure that the themes that you really care about, you've taken the time to understand the market question, because you're not going to have time to sort of check the box. You're going to be doing financial customer diligence, and that whole entire time frame has gotten condensed, at least in current environment from what I've experienced.
Yeah, I guess I wouldn't, our time frame's the same. There's so much technology we have to know in the early stages of technology investing in healthcare, but I would say what some of the things that have changed would be what you focus on. So regulations, patient privacy information that you have to sort out. Does the company actually have the right tools in place and processes in place? Where are they providing their service? For example, a company that I'm involved in, they have determined that the best place to be reimbursed for what they do is New York. So they moved all of their service organization to New York so they can bill all of it for Medicare out of New York for what they do. So you have to focus on, is that true? How sustainable is that? Is that going to catch up with you? Are you doing physician services, and out of which states are you doing this, and what regulations are overarching that? So some of the diligent aspects that you have to look at are different. We give ourselves a lot of time, maybe several months, always starting with the markets, but then a couple months with the companies as well, because there's not for me, as much time constraint.
Well, I think as you move from early stage investing to later stage, the diligence definitely gives up. It's just simple time. Like if a company's only been around for 9 months and you're asking them for a ton of diligence, it's pretty easy to say, like, show me your operating agreement and you can show me some projections, but we all know that's just smoke and mirrors anyway. So
well, and I hear that frequently. I mean, there's people who will talk about in this community, the diligence that it takes to get somebody to write me a $50,000 to $500,000 check versus the diligence takes me to $5. It's like you pray for your friends and family to be generous, because the diligence is exactly the same for a disproportionate amount of money. And I think we're trying to work within the angel community around the ability to help. That said, I think the diligence that we see, the discipline that gets built in those angel rounds is so informing into the construct of the company that it makes, you can tell those that have had angels that have really forced a level of discipline or been through a program, it does help in those out years really build in, I guess, girth.
And I think that's just good practice, right? Is having your books in order, having all your documents in one place, so when people ask for it, you can just send it on over. I think it's way easier for an early stage startup to have that and just be able to be like, yep, here's the information, here's everything, basically. We have nothing to hide on there. But the diligence at the startup stage is really around the human beings running the company, because that's really who we're making the bet on. Ultimately, who are those people? Do we think that they have a vision? Do we think that we trust in their ability to execute, and building that relationship over time? And what they've built is great, but you're really building that ultimate vision on there, and that's how you try to de-risk it, is building a personal relationship with the entrepreneurs running the company.
Yep. So one of the things that we talked about on the call as well, kind of just prepping for, there's too many topics to cover in the amount of time, was also the exciting opportunities from that the Convergence is creating, and to start to see where industries are bringing. I shared a perspective of, one of our portfolio companies we invested in is taking technology that was in fintech, doing all of the e-com and surveillance work for banking in partnership with HCA, applying that into healthcare, and doing secondary radiology reviews and taking those business models. 100 stage 1 cancer patients identified in ways that would have otherwise not been identified until they were much, much further along in the cancer journey, and the benefit that can make. Those are presenting some really cross opportunities. That was a fintech investment, so we're co-investors with NASDAQ. And you have opportunities where you're bringing that healthcare discipline and the financial services discipline. I guess to each of you, as we talked about, what areas are you most excited about? What are those opportunities where you look at and you think the market is really, really ripe for some investment? Allie, I know you've been thoughtful about your investment thesis, so why don't you kick it off for us about areas?
Yeah, hopefully it's not boring. Given we're a growth equity firm and sort of later stage, we're obviously not going to be investing in things that probably have AI and blockchain in their descriptions. Never say never. But in addition to sort of the regional sourcing aspect I alluded to, thematic sourcing is front and center for us. So the way that I am sort of developing themes is talking to key decision makers and really understanding their pain points, and that's often chief nursing officers, heads of supply chain and procurement, the CFOs of health systems, and having them tell me what their near-term pain points are, because I know that if they force rank them, they're probably going to actually put some capital against it. So that's driving a lot of sort of how we think about the market. Where that has ultimately led me to is I've been spending quite a bit of time in and around compliance. What we've found, even in very niche compliance solutions that may or may not be sold to the health systems, is they're really sticky. Once you improve the workflow and make his or her life easier from a workflow perspective, it's rare that someone turns it off. And so that's just sort of one aspect of the compliance landscape that we really like. We also see a ton of inefficiencies in and around healthcare supply chain. So we're looking all the way from freight management to inventory management to capital planning and allocation to disposal, and trying to understand where the pain points exist and figure out whether or not it's a roll-up strategy, or perhaps find one really interesting segment that's top of mind for or a health system in particular, and go after that. We've also heard a ton of pain points around workforce management. So nurses is a really good example. I mean, chief nursing officers talk to us every single day about how challenging staffing and time and attendance and scheduling is, and already in a world where there's so much turnover, how do we make or how do we tech enable the process and make people's lives a little easier. So when I was talking to a healthcare investor, a well-respected one, and I was telling her about Radian's mandate, she said, you guys are investing in rabbits, real actual businesses building interesting technology, not unicorns. And so I want to just to explain that that's the lens through which we're currently looking at the world. Most of our investments hopefully achieve our returns in sort of a sub 250, sub $500 million outcome. So I'm not looking to be on the front page of the Wall Street Journal with our investments, but I think there's a really interesting opportunity in that segment of the market for pain points that exist today need to be served.
Kathy.
One second, Allie. I have a blockchain supply chain solution for you. So we'll talk.
Maybe we'll consider that. Yeah.
So,
He's going to get blockchain in yours at some point.
and I've got it right here. With that, I'll actually respond to that question in two parts. One is I'll have the benefit of looking both at bottom of S curve as well as things moving up S curve in terms of maturity. So I look general at like spaces that, one, I'm excited to see tractions finally starting to get into. So solutions both for underserved and aged populations that traditionally didn't receive a lot of either digital health or other forms of investment, and solving those real problems. So it's exciting to see those starting to come online and get more investment, and that being a continual area of focus for us. So that's on the macro problem space. And to address those, we're really looking at solutions that are addressing labor productivity and location independence. We need to address the labor productivity. We need to get away from high-skilled labor doing everything, and also requiring you to go to physical locations. So how do you get that blend of physical and digital to actually connect those spaces or bring people to you in a way that's more productive? So that's key. On the buzzword side, that's where, so get ready, it's coming. So in that, I also am continually looking at areas within blockchain and how to actually apply those solutions. That's another place. I mean, if we go with all the discussion, we're basically seeing the pace and scale of everything just continue to speed up. So for something that's really emerging right now and still trying to find its place, it's amazing how fast it went from non-existent in healthcare to actually finding some use cases in the matter of 24 months. So still 5-10 years out, still very speculative, but there is a lot of interesting applications there, specifically as you look at things like patient identity and areas where we're not going to get a centralized solution. Also looking at different forms of artificial intelligence, and that's across, you name the type of solution, which can enable things like liquid workforces. So how do you do supply-demand matching using freelance labor? So you see a number of solutions out there for that. Extended reality being another way, so looking into augmented reality and VR, you're seeing that the prices are dropping, it's becoming consumer grade, so now you can start to bring therapies in the mix in that area. So I'd say those are some key areas on the bottom of the curve.
So I'm with you for the home-based care. I mean, and maybe it's for aging people, but it's really for anyone. So anything outside the hospital, we like a lot. We like hospital too if there's a huge unmet need and it's very clear and there are big barriers to entry. But we like alternative sites of care, home care for one, Surgery centers for another, especially surgery centers where physicians own them. Sounds like a bit of a conflict of interest, but the reason we like them is because the decision makers are easy to identify, and they make decisions quickly, and you can contract. We've contracted in a week at an ASC to get a procedure ready to go. Easy, and so that we like a lot because the decisions are fast. We also like disposable equipment, so you might know in surgical settings, oftentimes the procedure equipment is actually quite complicated, and logistics of it are very hard, and you have to sterilize it. And so we've moved to a lot of things where you actually can where it's plastic and you dispose of it and it's done. And that's especially attractive in the ASC environment because people don't have time or logistics to manage all of that. AI we like a lot, and AI is extremely important as it relates to all the data that we know is being generated out there. And so, the data are extraordinarily valuable, but the massive amounts of data, on the other hand, create a dynamic for the hospital and the physician that are not manageable. And so how do you then provide something back to the physician that's actionable, clear, fast, real time? And that's where the data become really valuable. And so tools that let you do that, so many of those will be regulated, which again, we like a lot. And so, there are a lot of things that we like, but I would guess most of them are actually non-hospital.
To add to that goes back to the points before on diligence. So it's interesting to look at the financial diligence here, but we're in a world where the connection of technologies under the hood are so complicated that it's very easy to say, I'm using artificial intelligence and it's on a blockchain and I have an extended reality headset in there and it's great and it's going to do all these things, and even demonstrate that it looks like it's doing that. When you actually flip the hood, it's like there's a bunch of people keying things and it's not actually doing that. So there's a point and then they hit a scaling point and realize that it cliffs because it's an interesting value prop, but there's nothing underneath the hood. So that's a very important diligence point, and you need some real specialized support on that.
We learned the name Mechanical Turks in one of our diligence that we had not. Bill's laughing. I mean, we literally we're an automated, digitized, automatically it happens, and this is awesome. Like, let's see the plug and where that goes. And behind the scenes, it was like the ESPN commercial with the guy in the bike. Only it was a bunch of people like entering data, trying to get it to go into the system as if it were automatically done. And that's on all sides of the system right now, I think, have that risk. All right, Ryan, you were going to touch
artificial intelligence, right? Yeah, exactly. So I guess, back to the conversations around kind of where we invest in what's interesting. With Matchstick, we don't actually have a vertical focus within healthcare or medtech. We actually are much more broad in thinking of like the enterprises and who the actual customer is, and that can actually very much take us into the healthcare industry. So a lot of it is actually around the future of the workforce and how we meet the new workers coming into our workforce on their playing field, so that we can attract the best and the brightest and allow them to work, succeed, and give them the tools needed to communicate, to schedule, to do all that stuff. And that can be in retail, that can be in healthcare, that can be in construction, it can be in whatever it is, and you see that kind of cross enterprise for us. So I may have some companies for you guys to check out for a later stage. Just kidding.
So we all know that Manova is the medical alley in innovation, so the Manova concept. So we'd be remiss not to have an opportunity to talk about what we're excited about here in this medical alley ecosystem. And for me, I'll take the privilege of going first, that I think that what I'm starting to see is this ecosystem really start to come, even this week being an example of the number of events that are taking place, from Minnesota Cup to Techne Award to Treehouse is having an event, and I won't name drop 200 different places, but I mean, it is, MedCity Invest is doing another pitch contest. I just did another. I mean, it is.
Techstars Demo Day.
You could rattle off all 200, actually, probably. But it is exciting, and you can feel the pace of change here taking place, and there are a number of leaders that are willing to lean in and lean forward. This conference existing, this conference drawing across food as medicine, ag, who knew we could get that excited about sidewalks? If you were here for 80/80 yesterday, right, and the implications that that can have on health, I'll tell you later. It was crazy, but crazy good, and crazy good. And I think there's a real sense that this community is starting to have. I gave Senator Frist the credit that he could say something as provocative as Boston didn't want to do heart transplants, so I left. I mean, you know, we don't throw that kind of shade in our Minnesota Nice. We kind of just raise our hand and hope that people will take a look. And that's one of the things that excited me about this conference was it was a firm stake in the ground, right? It was our Braveheart moment to say, here we are. We have relevance. We have an opportunity to bring something to the national conversation, let alone a local or regional conversation. And I'm really excited about the output from that. So, to my panelists, we knew we would close, and I think we're gonna have enough time to go rogue and ask for some questions from the audience, and we're small enough that I'm excited we can do that, which I know just put all of you into another level of nerves. But from that standpoint, I'll pass the mic on. So what are you excited about being in the medical alley, and a year from now, whether you want to take a risk of a prediction, a deal you're most excited about, a space you're most excited about, another buzzword you're most excited about, but medical alley, what are you excited about, and then a prediction for the future?
Me first, go. So I talked about the types of entrepreneurs that seem to grow and scale their businesses here, which is sort of first and foremost why I'm most excited about this ecosystem. But I think Ryan sort of epitomizes this given his breadth across sectors. But unlike other healthcare ecosystems, it's pretty unique in the Twin Cities in that the number of different Fortune 500 companies that reside here that have different sector expertise and diversity of thought and experiences, many of which have been earlier adopters of technology and then the healthcare ecosystem. I think there's a huge opportunity in Twin Cities to really cross-pollinate and make sure that the healthcare community is benefiting from what ag and retail, for example, have already experienced. And that's unlike, you know, Nashville, for example, at least from what I can see. And so I think that there's a really interesting opportunity here to leverage that. It's not prediction in a company. I too am really focused on Amazon, just given my interest in the supply chain, understanding how and when they will disrupt, you know, O&M and Medline and Cardinal and Shine and Patterson, and what the downstream implications are for the tech-enabled businesses that I'm most excited about. I think that's something I'm trying to figure out. Given every investor with whom I meet talks about MA and they're interested in investing there, I think that, you know, with some of the industry tailwinds that are pretty obvious and self-explanatory to this group, I think we will continue to see a ton of investment dollars flowing into that space going forward.
Yeah, so to add, Minnesota and the Midwest in general has a history of innovating within health and healthcare. I mean, with Mayo Clinic, with United Health Group, Medtronic, et cetera. So I think to see the renewed energy, to actually just amplify that in new and emerging spaces and continue the concerted effort is exciting to see how it can be a center within the Midwest. If I go the opportunity, it actually is aligned with what you were saying, Ellie. It's there's an untapped opportunity of collaboration that across retail, across ag, across traditional health, that even people within the local, even those businesses within the local community haven't fully connected how to do that even in the state of Minnesota, let alone broadly across the nation. So if you want to talk about interesting ways to compete about some of those other threads, imagine if you were to start to partner and do those in different ways versus trying to compete with each other. And I think you'll start to see that start to emerge in coming months.
I guess for the first question is you know what I'm excited about. Or I guess where I see trends is, I think as Minnesotans we do a fairly terrible job of saying like how cool we are and like what we've succeeded at and like what we're doing. Because whenever people come in to the state, they actually visit the startup community, they meet the entrepreneurs, they actually meet the people. They're like, holy cow, how come I didn't know about this years ago? Like, this is incredible. And I'm a byproduct of this. I'm from Iowa originally. I was in Minnesota and I was in Colorado. And I've been back here about 6 years now on that time. And just to give you some data, like this isn't just like a hoorah, like let's support the home team type thing. But like when we did our very first startup week, we had 20 events and 1,000 people, and we thought that was amazing. Like we were like, whoa, we just started this. It's gonna be great. This year we're expecting 200 events and 20,000 attendees. It's the second largest startup week in the country. from there. And we've got people flying in from all over the country who are coming here. And I get calls almost weekly from investors, from Minnesotans who live in different areas, and they're like, hey, I'm thinking about moving home. I'm hearing good things. And I think we finally have hit that tipping point of the narrative of this isn't flyover country anymore. This isn't like I've maybe someday I'll go there if my cousin gets married type thing. Like it's yeah, exactly, and it's only that time. But like people are using this as a destination. We're actually a node on the national network. And for so long, we were so protective and just thinking about, we got to do this. But now it's more about how do we connect? How are we part of that national conversation around supporting startups, and that we're actually a destination from this? And I think this conference is a massive testament to that we're able to bring everyone together in all these different verticals and fields and do that. So I would say the time is now. Like it is happening. Like Convergence is here. Like I think this is like an incredible testament to that. As far as what gets me excited, or I guess if we're just going to do some predictions out here, fearless predictions. That's kind of our job. Exactly. So I see a lot more interactions between the startup community and the corporate community happening, particularly in the Twin Cities community. We have 18, I think, Fortune 500 companies. We're seeing a lot of them come down and start to interact meaningfully with the startup community. So I would see a lot more partnerships between different organizations in all sorts of different verticals, of starting to see the local startup community as a source for innovation, and not just nationally, like you have to go to all these different places and fly on planes. Like this is happening in our backyard. And I'm starting to see more and more people accept that.
So I'll take a little bit of a historical perspective. So I think we all know that medtech's been strong here since the 50s, I guess. So it's been strong here for decades and decades. So to me, what's great that's emerged in the last 20 years is all sectors of healthcare are represented in a massive way. And then this cross-collaboration can occur because all of the sectors of healthcare are here. In fact, all the companies we invested, when they ask our advice about who should I talk to about this or regulatory, it's almost always someone from here that we bring to the table for them to talk to, because everyone's here. And so the collaboration and all of the industries across the spectrum are here, and that's what really, I think, separates this geography from anywhere else. And what I think too, then within medtech, traditionally there are a lot of entrepreneurs, of course, in the space, but I would say people tended to be in their 40s by the time they might have started a company historically, especially in medtech, and people get jaded by the time they're in their 40s, and they say that can't happen, you can't do that. So now we're seeing younger people that say, well, why not, and why not me? Right, and so it's risk taking, it's breaking barriers, it's just thinking outside the box. That is, it's refreshing, it's needed, it's really helpful, and I think that I see that just accelerating and becoming more and more the case here.
Well, I am actually getting the Manova sign for our time being up, so apparently no questions this time, despite the smaller group. I will. One, thank you to all of you. This was a panel that was very much just in their individual backgrounds, corporate backgrounds, and their view of this, really wanting to bring at least a little more provocative nature to the discussion of the implication to investors, so thank you for all of you. The layout of time didn't exactly show it, but there is a break now, Melissa, for 15 minutes? 15 minutes. So until 2:15, and then at 2:15 we'll start the fireside chats, one-on-one conversations with really amazing CEOs, founders, co-founders of companies that you will want to be a part of, both within Remedy and Color. So please come back at 2:15. Thank you.